Hello everyone, Anna from I Have Crypto channel here, and today I will tell you how the Fed's statements affect the cryptocurrency market and why it is important to take this into account as a part of trading strategy. Stay with me in order not to miss important information that will earn you more than 100%. So, what is the Fed? The Federal Reserve System is an independent federal agency specially created on December 23, 1913 to perform the functions of the central bank and expertise centralized control over the commercial banking system in the United States. The Fed includes 12 Federal Reserve banks located in major cities, about 3,000 commercial so-called member banks, a board of governors appointed by President, the Federal Open Market Operation Committee, and advisory councils. The basis for the creation is the Federal Reserve Act. The state plays a decisive role of the management of the Fed, although the form of ownership of capital is private, joint stock with a special status of shares. From the point of view of management, the Fed is the independent body in the US government. As the national central bank, the Fed receives powers from the US Congress. Independence and work is ensured by the fact that decisions on monetary policy do not have to be approved by the President of the United States or anyone else from the executive or legislative branches of government. The Fed does not receive funding from Congress. The term of office of the council members covers several terms of office of the President and members of Congress. At the same time, the Fed is controlled by Congress, which often analyzes Fed's activities and can change the Fed's responsibilities in a legislative manner. From 2006 to 2014, Ben Bernanke served as chairman of the Fed's Board of Governors. In February 2014, he was replaced by Janet Yellen, who served as its deputy for 2 years. Since February 5, 2018, Jerome Powell has been the head of the Federal Reserve System. Did you know about this, and what statements do you think can affect the cryptocurrency market? Write it in the comments. One word at the Fed's meeting and the US stock market will fall and rise. So what do the Fed meetings decide? So first is the US unemployment rate. The unemployment rate published by the US Federal Reserve System is a key indicator in the state of the economy and the labor market. The value of the unemployment indicator reflects the proportion of the active working age population who currently doesn't have a job but is actively looking for one. This indicator affects the number of important economic factors. First, the monetary policy of the Fed. The unemployment rate is one of the main benchmarks that the Fed relies on when making decisions on the key interest rate. High unemployment usually requires a looser monetary policy to stimulate economic activity and employment. Second is consumer spending. The unemployment rate affects the purchasing power of the population and the volume of consumer spending, which are a key driver for economic growth. Next is inflation expectations. A decrease in unemployment, as a rule, leads to an increase in wages, which can put pressure on inflation, and the Fed is closely monitoring the ratio. Next is investor confidence. The dynamics of unemployment reflects the general state of the economy and affects the investor sentiment of financial markets. Thus, the unemployment rate is one of the key macroeconomic indicators carefully monitored by the Fed and financial analysts to assess the economic situation and make investment decisions. The inflation rate, which is monitored and published by the US Federal Reserve System, is of great importance for the country's economy and monetary policy. Inflation reflects the general increase in the price level of goods and services over a certain period of time. This is a key indicator that, first of all, affects the monetary policy of the Fed. The main goal of the Fed is to maintain price stability, so the inflation rate is one of the main benchmarks when making decisions on the key interest rate. The Fed usually raises rates to keep inflation at bay. And it determines the purchasing power of the population. High inflation leads to the depreciation of money, reducing real incomes and reducing consumer opportunities. It also affects interest rates on the loans and savings. Rising inflation forces the Fed to raise rates, which in turn increases the cost of borrowing for businesses and the public. It also changes investment strategies. Investors redistribute assets to protect capital from depreciation. It also reflects the complexities of the economy. Low and stable inflation is a sign of a healthy economy. Thus, the inflation indicator is one of the key indicators that the Fed focuses on and which has a significant impact on the wide range of economic processes. The key rate set by the US Federal Reserve System is one of the most important instruments in monetary policy and has a significant impact on economic processes. The value of the key rate, first of all, reflects the cost of borrowing for banks. The Fed's key rate determines the interest rates at which banks lend to each other on a short-term basis. This affects all other interest rates in the economy. It also affects the availability and cost of credit. A change in the Fed's key rate leads to a change of interest rates on consumer loans, mortgages, car loans, and other types of loans. Lower rates stimulate consumer and investment activity. Third, it determines the profitability of savings. The key rate affects interest rates on deposits, bonds, and other saving instruments. An increase in the rates makes savings more attractive. It also affects the exchange rate of the national currency. An increase in the key rate usually strengthens the US dollar, as it makes dollar-denominated assets more attractive for investors. It is also used to regulate inflation. The Fed uses the key rate as a tool to curb inflationary processes in the economy. An increase in the rate slows down economic activity and restrains price growth. Thus, the Fed's key rate is one of the key levers that the Federal Reserve uses to manage monetary policy and influence the entire range of economic processes in the country. Why do you think these values affect the US market? And for cryptocurrency? Well, I'll tell you now. So what is the impact of the Fed meetings on the cryptocurrency market? The conclusion is quite simple: the confrontation between fiat and digital currency. The fiat money, dollars, euros, rubles, crashes, stock markets lose the interest of the investors, and interest of cryptocurrency markets is becoming more and more evident. That is why when Jerome Powell declares the inflation has remained at the same level or has increased altogether, the interest rate has to be raised. Investors begin to redistribute assets in favor of cryptocurrency. Then the opposite value occurs and the traditional market grows. On the contrary, on such news, the cryptocurrency loses the interest of investors. That's the whole point. How can you make money from this? My advice is not on a financial recommendation. I will only repeat the famous phrase: buy on rumors, sell on the news. As a rule, when there's big news that the event foreshadows the growth of the digital currency, it is most likely that the drawdown will be waiting for it very soon. This is beneficial for exchanges, large players for short positions and liquidations. Know this and use it to avoid falling for the tricks of exchanges and whales. And here I was here with you, Anna from the Eye of Crypto channel. Subscribe to my Telegram channel where I talk about what is happening in the cryptocurrency market here and now, and it will be very interesting.